Income Tax 2020, Tax Software Example, Self-Employed Business, Sole Proprietorship, Schedule C, Introduction. Come in, relax with Income Tax 2020. Here we are in our Lacerte Tax Software. You don't need the Lacerte Tax Software in order to follow along, although I do believe they have a 30-day free trial, so if you can get access to a demo version, it could be a good tool to practice with. We're going to be focusing in on the Form 1040 and then the Schedule C related to it being the schedule for a sole proprietorship or self-employed business. We'll be jumping back and forth from the data input to the form so that we can run different scenarios. The tax software, of course, making it easier for us to do so. We're going to start off with our basic scenario here, that being our single filer with Eric Smith, living in Beverly Hills 90210. He's got the W-2 income at the $100,000. That's where we're going to start. Then we'll move to the business income. And then we have the $12,400 on the standard deduction, and then the taxable income at the $87,600. If we mirror that then with our tax worksheet, then we have the same information in terms of our formula: $100,000 income, $12,400 standard deduction, $87,600 down here on the taxable income. Back to the tax software. The reason I want to start off with the basic scenario with a W-2 and then move to the Schedule C is so that we could see the impact of a relative change from the income coming from a W-2 income to the Schedule C and the added complexity that will come with that change. Also note that on page 2 now, want to focus in on the calculation of the tax here, that being at the 15,110. Let's write that down here. I'm going to say this is the 15,110. I'm just letting the tax software then calculate the tax there. That will then, of course, change when we add the change to a Schedule C. So now we're going to say, okay, well, what would happen then if instead of earning $100,000 in W-2 wages, the same $100,000 was earned, but with self-employed income? So we're going to have $100,000 income instead of the W-2 income. So a couple things that you might think of that were going to happen off the bat, or as soon as we make the change. If I go back on over to the W-2, note that when I enter the W-2, the employer will be taking care of the Social Security and Medicare withholdings, meaning we have already paid those. We paid them by the employer not giving us the money ever, right? They just took it out of our pay and paid it directly to the government for us. So one change that we're going to have for sure is the fact that we have Social Security and Medicare, not only the employee portion, but also the employer portion, the way the IRS kind of figures self-employment. That'll be called self-employment tax. So keep that in mind as we go. I'm going to go ahead and just remove this. We'll say, let's delete that. And then let's say that we got the old Schedule C drop down, and I'm going to say Schedule C. And so up top on the Schedule C, this is kind of the information up top. I'll get back to the information in a second, but let's just put that same $100,000 here and see what the impact will be. I will do so by putting income and expense in line items so you can see at least one line item for each. So I'm going to say income is $125,000, and then the expense, I'm going to just put advertising or accounting. We paid the accountant $25,000. That was, because it's a good accountant. So we're going to have that, and that's going to net out to $100,000, right? So the same $100,000 is going to be on the Schedule C. Let's just see what that will look like just in terms of the numbers first with regards to the software doing the calculations for us. So jumping on back over, let's see the impact of that change. So we have the same status up top, of course, same $100,000, but now it's not in the W-2 section, but down here on line 8. So line 8 is coming from Schedule 1, line 9. So this number is pulling one from Schedule 1, line 9. So here's going to be Schedule 1. Here is line 9. It's being included in line 3. Line 3, of course, is the business income or loss that's coming from the Schedule C. So that number is coming from the Schedule C. So if I go to the Schedule C, that's, of course, the main schedule. We've got the income up top, minus the $25,000 of expenses, giving us that net of the $100,000. That then is what's flowing forward to the Schedule 1 here, which is what is then adding up to line 9 and flowing forward then, of course, to the Form 1040 for the $100,000. Now, the other impact we have is this change. This wasn't there before. This is an above-the-line deduction, but to understand it, we're going to have to understand the calculation of the self-employment tax that we touched on. We also have this item down below, which is the qualified business income deduction, which may be applicable. We'll probably go into that more detail in the future, but that has an added form of Form 8995 or Form 8995A. Okay, and then on page 2, if I go to page 2, we also have a difference in terms of course, the tax calculation for federal income taxes due to the above-the-line deduction changes, and then that the difference in the deduction for the qualified business. And then we have the self-employment tax of the 14,125, which of course is significant down here now. We have the significant other tax that we have to calculate as we do the tax return, as opposed to just having the information for it being on the W-2 form, this being Social Security and Medicare. Okay, so let's go back to the Schedule C to see how this kind of flows through, how this all works. We're going to say, all right, there's the 100,000, there's the 25,000. The net income then is flowing forward to the first page of the 1040. Now note that when I think about this in terms of the equation, if I go back over here, it's basically going into line 1 of our income tax equation. But the thing that's feeding into line 1, which is basically gross income of our income tax equation, in other words, onto first page of the 1040, already has deductions involved in it, because when we look at the Schedule C, these expenses are basically deductions. Any expense that we had in order to help us to generate revenue is going to be something that we can reduce the income on, the business income. So we basically have income minus expenses, income minus deductions for the Schedule C, which nets out to that 100,000. That 100,000 then is flowing through basically to another income statement, and it's flowing through to the first, to the first section, to the income, basically gross income, that we will then apply the deductions on the first page of the 1042, that being the above the line deductions, and then the below the line deductions. So if I then go back to the Schedule C, we're going to say, okay, there's the 100,000. Now, we're also going to have to deal with the self-employment tax, which can add a good level of complexity. That's going to be on Schedule SE. So I won't go into a lot of detail on the calculation here, but we'll go into it a little bit more in a future presentation. But in essence, we're taking that 100,000 and we're applying out the Social Security and Medicare taxes to that. So the Social Security and Medicare taxes are usually, the amount that we calculated on the W-2 income when we enter the W-2 income. In other words, if I was just to enter, say, wages for just 100,000, let's say, 100,000, let's do 100,000, then it would calculate self-employment tax of the 6,200 automatically, because it's kind of like a flat tax. It's an easy tax to calculate as opposed to the federal income tax, which is a progressive tax. So 6,200 divided by 100,000 is 6.2%. And then the 1,450 divided by the 100,000 is 0.0145. So therefore, combined together, you'd think you'd have 0.062 plus 0.0145 would be the tax, which would be the 7.65%. I'm going to remove this now. I'm going to say, let's delete this and then go back on over. But notice they basically see you as the employer and the employee. So it's not exactly this calculation, but basically that means we're going to take this and multiply it by 2. And that would be about, this is approximation. This is the 15.3% times that 100,000. Now they reduced it a little bit, the 100,000, but let's just say the 100,000, and that would be the 15.3. Now it's not exactly that, but you could see basically it's similar to basically twice what you would be paying in the W-2 wages, because you're only paying the employee portion, and now the IRS thinks of you as both the employee and employer, so it's in essence doubled. And so again, it'll be a little bit different. We'll go into the actual full calculation later, but there's the 14,129 of the self-employment tax then. That's what's being included on that then pulls forward that 14 to the other taxes here on Schedule 2, which flows forward to the bottom, and that flows then to the 1040 page 2. So 1040 page 2, we have this 14,129 that we have to be including, which again, we don't typically see for if we're just the W-2 wages. We're only calculating federal income tax for W-2 wages. If we have self-employment income, then we got to deal with Social Security and Medicare and deal with the self-employment taxes as well. Okay, so note that if you were kind of matching this, so what the IRS is trying to kind of match this to what would happen with a Schedule C type of business. So in a Schedule C type of business, the employer would take out half the Social Security from the employee and report it in the W-2, and they'd also get a deduction for the employer portion as well. So you would think, even though I'm paying the $14,129, if I'm going to kind of match what would happen in an employee-employer relationship on a Schedule C, then I should get to deduct half of that for federal income tax purposes. But I can't really put that on the Schedule C, right? Because if I put like half of that deduction, which would be like kind of like payroll taxes on the Schedule C, it would then adjust the net income, which would adjust the calculation that we saw on the Schedule SE. You'd end up with a circle reference. That means that half of that deduction they're going to deduct somewhere, but not on the Schedule C. So in other words, we're taking half of this deduction, which is this $7,065, deducting it kind of like a business expense, but not on Schedule C, so we don't result in a circle reference because it's not something that can be deducted for self-employment taxes, which is Social Security and Medicare, but can be deducted for federal income taxes. Therefore, it's going to be on the Schedule 1 as an above-the-line deduction. So there's that $7,065 rolling down to the $7,065 here. That then is going to flow forward to the 1040. That's where this $7,065 comes from. So those are the main kind of things that you gotta add to and think about with the Schedule C type of business, just in terms of the data input, just in terms of basically entering the data. And then of course we have the qualified business income down below, which is another calculation that could be applicable to the qualified business. We might talk about that later, but obviously that could be a significant factor as well. So these are some of the things that just adding the Schedule C kind of relates to. Now notice again, if you're just doing like gig work, like a side Schedule C, then it's not as complicated to enter it in. It'll have this impact, but if they have W-2 income and a Schedule C, then maybe you don't have to do as much planning and whatnot because the Schedule C is kind of side income. They're not reliant on it. But you'll also have to be thinking about if they are reliant on it, or the more Schedule C income they have, you're going to have to be thinking about planning type of stuff as well. So then you're going to be thinking they're not getting withholdings now from the W-2 wages from like filling out a W-4 from their employer. So they might have to start making estimated payments. So you're going to have to start advising them with planning. So do you want to get into that or not? Do you want to pick up these clients where you're going to pick up planning? Could be a big opportunity. It could also be something that's outside, once again, your business model, depending on what your business model is. So you're going to have to say, hey, these are the estimated payments. Software can help you to determine what the estimated payments they should be making in the future is. So that's another kind of factor that you're going to want to be considering. Also note that some of the things that we touched about in a prior presentation, including whether or not they want to put money into like an IRA, or whether or not if they have a sole proprietorship, they want to set up a SEP or a simple, some type of retirement plan to take advantage of higher amounts that they could possibly put into a retirement plan and possibly be useful for for employees as well. If they have employees, then again, that adds a level of complexity in terms of payroll taxes and how to deal with the payroll taxes in terms of whether or not you want to help them out with payroll taxes and how you're going to enter the payroll taxes into the system here. You could also have issues, as we talked about before, with relation to the self-employed health insurance. Do they have access to health insurance elsewhere? If not, are they able to have a deduction here for self-employed health insurance? And then again, there's going to be questions in terms of they're going to be asking you possibly on advice about these types of things. Should I set up an IRA or a SEP or a simple self-employed plan here? How come I owe taxes, or what are these penalties happening here? What are these quarterly payments that I have to be making? Because I've never, if they're new to a Schedule C business, they may never have made quarterly payments before, because you're used to basically the employer just taking money out of your wages. So you've never actually seen the fact and had the painful experience of actually physically writing a check or wiring the money directly from your bank account to the IRS. So it can be difficult to make that adjustment. Right? Once it's in my account, it's hard to write a giant check to the IRS quarterly. It's easier when the employer does it and I never see the thing, or something like that. So you got to deal with the planning kind of situation. So again, when you are picking up your tax clients, and then you're going to want to think, do I want to pick up the Schedule C type of businesses, or what kind of clients do I want to focus on? Simpler tax returns or more complex tax returns? And that usually comes down to, am I doing fewer tax returns for more high-income individuals typically and getting larger profit margins, or am I doing more tax returns for lower-income individuals typically, which means simpler returns generally, and I'm going to have a bigger volume even though I have a lower profit margin? That's usually what you want to be considering. And again, if you're doing higher profit margin areas, you're going to have to focus in on those higher profit margin clients. That's where you're going to want to be. And then you might not be doing as many returns for lower profit margin clients. And if you're focusing on doing lower profit margin but more returns, then you might have to turn down people that have more complex returns. You're just going to have to say, look, I have someone else that we can refer this to, possibly have a network of people that you can be working with, but that's outside of my business model. It's not that I can't do it or whatnot. It's just, that's not what I do. It's not within my business model. And managing the clientele that you're picking up can be a difficult, it's a difficult thing to manage. So in any case, if you were then to enter this into something like the tax software over here, then I'd say, okay, now we have nothing on the income side, and then you could go to the Schedule C. Now you might double check the entering into a Schedule C. I would actually use a whole nother worksheet to do that, to do a trial balance worksheet, depending on how complex the return is. I may talk about that more in the future, but we could do basically another income statement right here, right? I could say it's 100,000, and then we had business expenses of 25,000. It was 125 up top, 125, and then the 25, and that's going to get us down to the 100,000. That's going to feed forward to the first page of the 1040. Now we still have 100,000, but it's coming from the Schedule C. And then we're going to have an adjustment to income. That's going to be the self-employment, half of self-employment tax. You could do the calculation for it here, or you might depend on the software to do it. So I might then go and depend on the software and say, okay, self-employment tax, I get half of that, which is 7,065. So I'm going to say 7,065. It would be better if you kind of do the calculation on it yourself, or again, you might depend on the software to do the actual tax calculations on it. And then you also have this calculation up top for the qualified business income deduction. Again, this can be somewhat complex here, and you might be somewhat dependent on the tax software to help you out with the calculation to get the exact number of that. So when you verify it, you might be somewhat dependent on the tax software. We may talk about that more in the future, but I'm going to put that here, and that's going to be the 16107. So 16107, and then that's going to pull forward. So if I check this out and I go to the first page, now I got the 100,000. That looks good. I got that, and then we're at the 92,935. So that's going to be 92,935, and then we have the standard deduction, the 12,400, and then the 16,107 to get to the 28,508. So we're looking 28,508 here. Taxable income, then the 64,428. So then taxable income, so 64,428. Combining these together, that's the 28,507. So there we have that. We can get to this basically taxable income. Again, we might be reliant on the tax return to be calculating, say, the self-employment tax and possibly the adjustment, or we could take this adjustment from half, the self-employment tax. And then on the second page, we would then have part of the second calculation, which would include the federal income tax. So notice the federal income tax, if I put that over here now, which is this 15,110, now the federal income tax is 9,964. So 9,964, it's lower than what we had for the 100,000 because of some of the deductions we had, like the self-employment tax and the business, and obviously this big guy here, which is the qualified business income deduction. But then we also have the self-employment tax, the other tax here, which is the 14,129, which we didn't have for the W-2 income. So the other tax that we're going to be having then is going to be for the 14,129, 14,129. And so that's going to be, of course, $24.93. So we have more tax substantially on the Schedule C due to the fact, of course, that we're dealing with the self-employment tax. Now, remember, the self-employment tax was already paid when we had the W-2 income, but it was taken out already for us. It's not something that we really see or have to deal with on when we calculate the 1040. It was taken out of the W-2 wages for us. So again, it's kind of shocking sometimes if you work from someone that has a W-2 income and then they go to self-employment tax because they're like, what is that self-employment thing here? And it's really kind of increasing the taxes. And you got to be able, it is, but it's also something that you deal with at least half of it on the W-2 income. But it is a substantial impact. So if you're questioning whether to be a W-2 employee or a Schedule C business, if you have the option between the two, the self-employment tax is a significant impact on it. And the fact that you have to pay the employer and employee portion can be a downside to it. Although, obviously, on the self-employed income, you get to deduct the business expenses here, which could be a benefit as well. So that's how you can kind of think about it and double check it in basically the tax formula. You can see there's a lot of different impacts that will be affected. And again, there's a lot more planning opportunities once you get into a more complex return, which could help you in the off season to earn revenue in the off season by basically reminding people to do the estimated payments and basically doing tax planning type of scenarios and helping them to work with other people to set up retirement plans or something like that if they need him for the business, a SEP and this type of stuff, and just to do tax planning for the future, all potential revenue sources. But again, they're going to be revenue sources that you want to make sure are within your business model.